Coming now to section 4, inventory method changes. Very occasionally companies change the inventory valuation method. What does this mean? So a company has been using FIFO, and from FIFO it is moving to LIFO. This is acceptable if the company can justify that this change results in more reliable and relevant information. But when a company does make this change, the change must be applied retrospectively. There are some exceptions to this, but generally a company would need to also then show LIFO numbers for previous years. And this has to do with the fundamental principle of comparability. If you are analyzing a financial statement and you are looking at inventory numbers over the last 3 years, then obviously you would want to compare inventory numbers reported using the same method. You as an analyst need to carefully analyze why a company is making the change. At times the company might have a valid reason, but it is also possible that a company is doing this simply to reduce taxes. Or a company might be making a change to show a higher reported net income. Obviously, if a company has such intentions, it might not explicitly say so. You as an analyst need to go under the covers and try to figure out what's going on. Next point, inventory adjustments. And this is mostly material that you have seen at level 1. The high level point is that at times inventory numbers come down in the sense that you have been purchasing inventory at say $10 per unit, but now the price at which you can sell is less than 10. What does the principle of conservatism demand here? That you write down your inventory. So what are the rules around writing down inventory? IFRS says that on your balance sheet, the inventory number must be the lower of cost or net realizable value. What is net realizable value? This is the value at which you can sell minus any selling cost. If your cost was 10 and the net realizable value is 8, then you need to write down to 8. The difference between 10 and 8 is 2. This 2 is shown as a loss on the income statement. If there is a recovery in value afterwards, so from 8 now, the net realizable value goes up to 11, then what can you do? Under IFRS, you are allowed to write back up, but only till the original value of 10. That point is made over here. So these are the rules under IFRS. What about US GAAP? US GAAP says lower of cost or market. Now there is a subtle difference between market price and net realizable value. Net realizable value takes a selling perspective, saying that if you sell and then you subtract the selling costs, then the number you end up with is the net realizable value. Market cost or market price means that if you go to the market and try to buy this again, how much will you buy it for? In many cases, those two numbers might be quite similar. Market is equal to the replacement cost, which is what I just described. The market value has an upper limit of net realizable value and a lower limit of net realizable value less a normal profit margin. So all we are saying here is that you might come up with a market price of say 7, but this 7 needs to be within a certain range where the high end of the range is net realizable value and the lower end is net realizable value minus a profit margin. This material was covered at level 1. I don't think it is overly significant in terms of the level 2 exam. This point, however, is significant, that under US GAAP, once you write down, you are not allowed to write back up no matter what. How is this different from IFRS? The difference is that with IFRS you can write back, you can write up, but till the original amount. What is the impact of inventory adjustments? This is more important from a level 2 perspective. The inventory write down reduces profit. Obviously, we just showed the fact that when we went from 10 to 8, inventory was written down. Where was the 2 shown on the income statement? It is shown as a loss. But where exactly is it recorded? This 2 is reflected in terms of a higher cost of goods sold. Higher cost of goods sold means that your profit comes down. Also, the inventory write down reduces the carrying amount of inventory. So in the example we just saw, 10 is written down to 8. This is the value of inventory. When you do inventory write downs, that will have a positive effect on activity ratios. Why is that? Because generally with activity ratios, you will have a balance sheet item such as assets in the denominator. With a write down, this becomes lower, so the ratio will be higher. So a company that wants to show that it is more efficient or operating better might actually do write downs. On the other hand, inventory adjustments will have a negative effect on other ratios such as profitability ratios, liquidity ratios, and solvency ratios. Why a negative effect? Clearly with profitability, your profits are going to come down. Will sales be impacted? No. So the profitability ratios will be worse. Liquidity ratios like current assets over current liabilities will be lower because your current assets are lower. Solvency ratios will be higher, which is actually a negative. Companies using specific identification weighted average cost of FIFO methods are more likely to incur write-downs relative to companies using LIFO. Why is this? If you think of my simple 112233 scenario, with companies using LIFO, the inventory value is relatively low, so the probability of a write-down is low. Companies using FIFO, for example, will have inventory that is valued higher, so there is a higher chance of write-downs. Now, something for you to remember, this inventory write-down is a valuation allowance. You might recall from level 1 the concept of a contra account. Contra account is something that reduces the value of an asset. Just like depreciation is a contra account which reduces the value of long-lived assets. Similarly, the inventory write-down is called a valuation allowance, and this reduces the value of inventory on the balance sheet. Let us now take a look at example 5, which deals with a company called Volvo based out of Sweden, which is using the FIFO method. And this particular company also uses inventory valuation. So they write down the value of inventory based on certain estimates. There's a separate video that goes over the calculations in detail. I'm just going to give you the high-level principles over here, and then I want you to try and solve this example on your own before looking at the solution. The principle here is that if you have a company that reports numbers like this, so it reports net inventory equal to say 3,000. So net inventory means that this is the number reported after deducting the valuation allowance. And then you are told that there is a valuation allowance equal to say 500. And you are asked what would the inventory number be if you want to pull out the impact of valuation allowance. It would simply be 3,500. So that is fairly straightforward. And if you look at the working in the curriculum, the real challenge is looking through the various footnotes and trying to extract the relevant information, but the principle is this. Next question, assuming that any changes to the allowance for inventory obsolescence, so this is the valuation allowance, are reflected in the cost of sales, what would Volvo's cost of sales be for these years if it had not recorded inventory write-downs in these particular years? The first point to note here is that we are dealing with an income statement item. And since this is an income statement item, we will be looking at a change. Our starting point is the reported number for cost of sales. Let's say the reported number is 2000. This is not the same number as the curriculum example, but I'm illustrating a point. This is your starting point. But this reported number is after subtracting the valuation allowance. You want to remove that impact. Let us also say now that over this particular year, the valuation allowance increased from 200 to 250. So what was the valuation allowance charged in this particular year? 50, which is the change. It is the ending number minus the beginning number. If we were not dealing with the valuation allowance, so we are not counting this 50, then what would the COGS be? Would it be higher or lower? It would actually be lower. It would be 2000 minus 50. So that's all you really need to do. When you are looking at the income statement number, you start with the reported number and then subtract the change in valuation allowance. The next point is, what would the impact be on net income if the company had not recorded the write-downs? Would the income be higher or lower?
Higher.
Obviously, the income would be higher if the write-downs had not been recorded. So what you do here is you look at the change in valuation allowance. Again, net income is an income statement number by definition. So you will look at a change. Let's say the change is 50, but we are talking about net income, which is after tax. So you will do 50 into 1 minus the tax rate. All right. The principle is straightforward. There is a separate video that goes through the actual numbers in detail, but as I said before, you should try to do it on your own before looking at the solution. Here is a quick concept check, and something like this is more likely to show up on the exam. The question is, what is the COGS if you adjust the figures to assume no valuation allowance? What is your starting point? It is the reported number, and this reported number does include the effect of inventory write-downs. Now, I've given you multiple pieces of information over here. This is what's shown on the balance sheet and associated notes. The reported number is 450, which is the gross value minus the valuation allowance. But then there is a footnote which says that the charges included in COGS for inventory write-downs are only 40. This number is different from this. The reason is the valuation allowance deals with the overall inventory. Not all of that inventory is sold. When you are dealing with cost of goods sold, you need to only worry about the valuation allowance which is applied to the inventory that was sold. And I highlight this because it is one of the most tricky questions in the reading, in the practice problems. So you are actually going to deal with this 40. When you remove the impact of this 40, what will happen to COGS? Will it go up or down? COGS is actually going to go down. So the answer is going to be 2000 minus 40. So that is your answer. We now come to the final section in this reading, which is financial statement analysis issues. I think this is fairly testable because what we are going to do here is study the financial statements and try to make a determination about the company that we are studying. In the context of inventories, companies are required to report in their footnotes the subcategories within inventory. So you will find information related to raw materials, work in process, and finished goods inventory. Now, increases or decreases in these components send different signals. Most of this is fairly logical, but I'll give you a few examples and scenarios. Let's say that you notice that the raw material inventory and the work in process inventory is increasing. What can you as an analyst conclude or deduce from that? Chances are that if a company is ramping up in terms of higher amounts of raw material and work in process, then it expects high demand. So this will be taken as a positive signal. What if finished goods inventory is increasing? Now then it depends. If finished goods is increasing, but the raw material and work in process is decreasing, then it might appear that there will be a decrease in demand, or there is a decrease in demand, because when does finished goods inventory build up? One of the reasons might be that people are not buying, the customers are not buying. So if finished goods is up but raw material and WIP is down, then this would be a negative sign. On the other hand, if finished goods is up but raw material and work in process is also up, then that could be a positive signal in that the company is expecting higher sales. So you need to look at the various components carefully, and you need to also understand why this is happening. Before you jump to a conclusion, try to investigate the reason for the changes. As an analyst, you should also compare the growth rate of sales with growth rate of inventory. Ideally, they should be in the same ballpark. But if you have a situation where inventory is growing at a fast rate, but sales is growing at a lower rate, then that will be a cause for concern. And that would obviously mean that finished goods is possibly going up. So you need to look at this. As we saw earlier, a company was using a valuation allowance to deal with obsolete inventory. This is a fairly subjective area. So if you are comparing 2 or 3 companies, it is possible that they are fairly similar, but their approach to obsolescence is different. One might be more conservative and taking a larger amount of valuation allowance. Another might not be using a valuation allowance. So what do you as an analyst then do? You then need to make adjustments, so you compare apples to apples. You should anticipate inventory write-downs. If you observe that the finished goods inventory is going up at a faster rate relative to sales, and you suspect that this material will not be sold, then a smart analyst will make an adjustment before the company reports an adjustment. An obvious point is that when comparing companies using LIFO with companies using FIFO, you should convert LIFO numbers to FIFO numbers first before comparing ratios or comparing other financial statement elements. I want you to do example 6, which illustrates how to compare companies. There is nothing new over here, so I'll not go over the example in class, but I want you to try and do this on your own. Then also take a look at example 7, which deals with management discussion and analysis. This is a fairly straightforward example. We have touched on this material before, but it's important enough, and as we conclude this reading, it makes sense to again look at various ratios and how those ratios compare across different inventory valuation methods. Assuming stable inventory and rising prices, what happens to profitability ratios under LIFO and FIFO? Under the LIFO method, COGS reported is higher, which results in lower net income. Any profitability measure that includes COGS will be lower under LIFO as compared to FIFO. So we have discussed this. Think of this as a summary slide. What about liquidity ratios? The moment you see liquidity ratios, the first and most important ratio that will come to mind is current assets over current liabilities. Under LIFO method, lower inventory is valued on the balance sheet. A lower inventory will report a lower current ratio and a lower working capital ratio. Activity ratio. Under the LIFO method, COGS is reported at recent prices, while inventory is valued at lower prices. Thus, inventory turnover is higher and the number of days of inventory lower for firms using LIFO. And solvency ratios. LIFO results in lower total assets compared to FIFO, which results in higher debt to equity ratios, higher debt ratios. Remember, with solvency ratios, a high ratio is a negative. Continuing with the summary. So, in an inflationary environment, which means that prices are going up, what happens to ending inventory in FIFO versus LIFO? We've done this enough times. The ending inventory in FIFO will be higher relative to LIFO. And what about COGS? It will be lower in FIFO relative to LIFO. What about an environment where prices are going down? Here we will have the opposite. So ending inventory will be lower under FIFO and COGS will be higher under FIFO. LIFO versus FIFO, you need to know how to make the adjustments. So how do you make the inventory adjustment? You say FIFO inventory is equal to LIFO inventory plus the LIFO reserve. This is a balance sheet item, so we take the overall LIFO reserve. What about COGS? Your FIFO COGS is equal to LIFO COGS minus the change in LIFO reserve, and then retained earnings. This is a balance sheet item, so FIFO retained earnings is going to be equal to LIFO retained earnings plus, why do we know it is a plus? Because it is a FIFO earnings will be higher, and this is a balance sheet item, so it's going to be the LIFO reserve into 1 minus T, because we want to subtract the tax effect. Alright, so this LIFO reserve is clearly important. LIFO liquidation happens when you are using the LIFO method and your sales exceed the number of units purchased, so you are dipping into older inventory. That might make the gross profit appear higher than it should be. Then we talked about inventory adjustments, two major points there. Under IFRS, with inventory adjustments, you write down. So if your net realizable value is lower than your original cost, then you write down. If necessary, you can write back up, but only up till the original amount. The write down reduces the amount on the balance sheet, and the write down also increases cost of goods sold. The higher cost of goods sold results in lower net income. And then ratio analysis is important. We just did this on the previous slide. That is it. As always, I want you to read the summary in the curriculum, go over the learning objectives, make sure you can say something sensible about every learning objective. Do the examples. I have covered most of them. There will be some additional videos for some examples. Do the practice problems at the back. There are 3 case studies which are all extremely good, and if you have time, also do practice from other sources.